Every year at this time, we look at our projections for the future and make some adjustments. Markets change, the numbers change, the data changes, and so it gives me an opportunity to answer that question that I get asked probably most frequently of all the questions I get asked, which is, what do you think the market's going to do? And so while I might not have an answer for you about the next month or even the next year, when we get into longer time frames, such as decades, we definitely do have some answers. And these are the same inputs that go into our financial planning system that all of our advisors use when they're working with you to talk about your specific plan. So let's go ahead and launch into this. First, just a conceptual idea, just to sort of get our minds in the mode of thinking about the future. We're going to have a set of projections that goes out 20 years. We're going to talk about equities. We're going to talk about fixed income. And I want to remind people that financial plans can cover a much longer time frame than that. Often when we're talking about legacy gifting, passing assets on to the next generation, we might be talking about a very long time frame. Certainly for some of our clients, that could be 50 years or more. And so that will actually exceed the time frame that we're using for our projections. So things could certainly change. And then honestly, there's going to be some financial plans that have major events coming up in 5 years or 10 years or something like that. And particularly as it relates to fixed income right now, now that yields have dropped once again to near zero for most parts of the yield curve, we might not actually make as much in fixed income as the plan is suggesting. So my point is that there's some different time frames. There's just an awful lot of complexity of this exercise. The good news is that all of our advisors are very well trained on how this works and how to make adjustments and how to frame this for you. So just a little bit of a disclosure there. As we get into the meat of things here, here's one of those tables, and we're drawing some yellow circles around a couple of columns, and I just want to call your attention to something. Now, we're looking on this page at a lot of different parts of the equities market, the stock market, if you will. Most of that's what we would call public equities, but we even have some information in there about some of our hedging strategies and the private equity market. The most important thing to us as investors is the returns that we're going to make after the effects of inflation. And so on the left-hand side of this table, we look at history. And in this historical view, we're going back 19 years, which seems like a kind of an odd time frame, but we can only go back 19 years if we want to capture some of the subtleties of how we invest. There are certain indexes that don't have a 100-year history, and in this case, only have a 19-year history of breaking out the difference in performance between large companies and small companies overseas, which is an important part of how we invest. We overweight small caps. So we look back 19 years, but our projected returns going forward, that's the right-hand side of the chart, and for the next 20, is informed by more than just that 19-year history. My main point here is that when we look at the stock market, we're really not projecting anything that's radically different from what we've seen over the 19-year history that we're documenting here for you. But again, as I added, even longer histories than that. So we might see, for instance, that emerging markets, which is about 2/3 of the way down, actually did really well over that 19-year history. Not so much lately, but that 19 years looks pretty good. But over an even longer term, wasn't quite the top performer. So we take all that into account when projecting the future. And again, it's the returns after inflation, which we project to be about 2%, that really is the money you're going to get to keep. Now that's equities. Let's flip to fixed income and talk about that. When we look at the returns for fixed income historically, and we're going to stick to this 19-year period for the purposes of consistency, one of the things that might jump out at you is that returns on cash over the last 19 years haven't even kept up with inflation. For instance, the average cash return has been 1.47%. Inflation's been just a hair above 2%. So actually you lost about 0.5% to inflation if you were invested in cash. Clearly, if you go back over longer periods of time, that wasn't quite the case. In fact, just a year or two ago, we were we were finally beating inflation with cash, although that's gone away now with the plunge in yield. So when you look forward to what we're expecting, you'll see that the returns in some cases might look a little bit optimistic. We actually think over the next 20 years that we're gonna equal the rate of inflation, that 2% number that we've projected with cash. You certainly can't do that right now, but we think over a 20-year period you can. So we've got those expectations for the future. And again, there's nothing too radical there. We did lower our expectations for the return on cash over the next 20 years because of what's going on right now. But there's no big surprises. There shouldn't be anything that's too startling when you go through these numbers with a fine-tooth comb later, which I know some of you will. Now, we're getting into the part of the presentation where I'm going to talk about the past to just kind of let you know how we've been doing with what we call back-tested returns. And we use this concept of back-tested returns because most of our clients have something very unique about their portfolio. It might be a favored stock holding that we're not getting rid of yet for tax reasons, might be some individual bonds that we've got. So there's just a lot of uniqueness, of course, on the private side, but even so on the public side. So we're going to talk about what our model returns have done. And in this case, we're going to look back only 3 years. I promised you that some of these tables would be a little bit hard to infer meaning from. So let's go to a chart version of this, and I'm going to spend just an extra moment on this particular look back before we go to longer periods, because there's kind of an important concept that I want to get home. So there are 2 lines on this chart. You can barely tell that because they really run right over top of each other. The reason we have 2 lines is we want to look at how our model portfolios have done and compare that to something. You need a yardstick. You need a measurement to say, are we happy with that? Do we wish anything were different? And in this case, these 2 lines more or less cross over each other. I'll tell you what I would have liked to see, and I think it's something that all of us would have liked to see. If we really could just create our own world for investments, I think what we'd like to see is that we took as little risk as possible. And if you look at the horizontal axis, that's the one at the bottom that goes from 0% to 20%, all things else being equal, gosh, wouldn't we all like for the risks to be 0, right? We'd love for the risks to be 0. And if you look at the vertical axis that goes from 0% to 12%, we'd love for the return to be as high as possible. So if somehow there were a marker, a dot, a place on the line where we've been able to invest that had 0 risk and 12% return, that would be the ideal. Now, you know, I'm being facetious here. Any of you that knows anything about investing knows you can't get a nice return for no risk on a reliable basis, but that would be the ideal. And since we know that's the ideal, we can judge anything we do by saying, how close is it to that point on the graph? And again, that's the top left portion, or the northwest portion, as we might say, low risk, high return. And when we look at this chart, we can see the way we invested in green. We can see the way the benchmark performed, which is global equity and U.S. fixed income, everywhere from 0% in equities all the way up to 100% in equities. And of course, we can conclude none of those is any closer than any other to that ideal spot, meaning on a risk-adjusted return basis, we didn't do any better, we didn't do any worse in terms of how the returns we got for the risk that we took, okay? So hopefully I've laid the stage there. I'll just refer back to a few of those key concepts as we go forward. Let's look back a little bit farther in time now to 5 years. Of course, there's the table that you'll get a copy of. Let's go ahead and go to the chart and see if it looks like it did for 3 years. Well, it doesn't quite look the same. There's some differences that begin to emerge, and this really begins to illustrate the point. And you'll have seen some of this in your own quarterly portfolio reports that you receive. So let's remember again, the place we'd like any portfolio to be is at very low risk and very high return, that top left part of the graph. Nothing's there, but some things are closer to that than others. So if you look at the chart for how our portfolios have performed, that's the green line, you'll see that we talk about a 0% equity portfolio with the bottom part of that. That means all fixed income. And then you look at 100% equities at the top, and there's everything in between. Remember, these are the returns you get after inflation. So you look at those and you say, well, the green line of portfolios is superior to the red line of portfolios, at least by some measure. It's closer to that corner where we'd like to get. Now, there is another completely valid interpretation of this chart that says, well, if you are 100% in equities using the benchmark, well, that return was actually higher. That's more like 8% instead of about 7%. So if you looked at your quarterly portfolio report and you were 100% in equities or 90% in equities or even something less than that, you likely saw that your portfolio didn't have as much return as the benchmark did. Now, what we haven't been able to tell you so far, this may change in the future, is that you took way less risk to get there. So your portfolio was less volatile. Hopefully it was not as emotion provoking. If you look at the return we got for the risk that we took, our portfolios were superior. If you look at the absolute return in comparison to the benchmark, our portfolios didn't quite keep up. One more sort of note of disclosure, when we're measuring risk, we do that with the standard mathematical measure that everyone in this business uses, which is something called standard deviation. And we're not going to spend time going through what the equations for that look like, but that is sort of the standard accepted practice. Let's go to 10 years, and we're going to start to see the story evolve a little bit more. Again, the table, kind of cryptic and hard to decipher there. But if you go to the chart for 10 years, now we're getting a little bit of a different story. So I don't suspect there's too many people on this call that have been with us for 10 years, but some may have, and the firm's been in business for more than a dozen years. But if you look at the two lines of available portfolios, now you really start to see the kind of picture that we would hope to see. So if you look at the green lines, well, there's 0% in equities all the way up to 100% in equities. And it's just easiest to first look at 100% in equities. So we've got an amount of risk that's sort of in the middle of the chart. The standard deviation is a little bit less than 10%. That just means that there's not a lot of ups and downs in the value of your portfolio, although most of you don't mind the ups. It's the downs you don't like, right? And from a return standpoint, after the corrosive effects of inflation, the return was nearly 9%. Now, if you look at the benchmarks, in most cases, the return is a little bit less. But the risk is definitely higher. So the benchmarks had wilder fluctuations and slightly less return. So if you just compare the risk you took for the return you got, then it looks like our portfolios outperformed. In fact, in many cases, they outperformed on an absolute return basis, at least gross of fees. This is all gross of fees to provide the most objective comparison that we can use across all portfolios. Now, again, when we say our portfolios were superior or did better, it's with this risk-adjusted return in mind. And the easiest way to do this visually is say, which set of portfolios is closer to that top left corner of no risk and high return. So we're kind of liking what we see over the 10-year period. Let's go back as far as we can go now, which would be 19 years. There's the table. We'll go ahead and flip to the chart and say, what do we see now? Well, fortunately, we see a similar pattern. Now, I will make the point of saying that when we get to the left side of those two lines, where we're really talking about portfolios that are primarily fixed income, we're looking at back-tested returns that actually go beyond the life of the firm. You'll remember that I said about 12 years, but we're taking what it is that we do and we're just running it backwards in time. I remember 19 years back when I was in this business, and when you built a fixed income portfolio then, it was certainly very common to own 15 and 20-year bonds. We don't tend to do that now, so we're very much sticking on the short end of the yield curve, as we say. So shorter bonds because we've all been worried at least that interest rates might go up. Instead, they've come down. So I'm not sure that we would have 19 years ago been managing the portfolios exactly like that. I think we might have been owning some of those longer term bonds, which actually would have done a little better. But nevertheless, just to be fair, we're taking what we do and we're running it back 19 years. And for the most part, the green portfolios are doing better than the red portfolios. They're most clearly doing better from a return standpoint, and in most cases, the risk is a little bit less. So in some periods of time, in conclusion, looking back, we were winning on risk. In some cases, we were winning on return. If you look at risk-adjusted return, we were winning over most of those longer time frames. Not so much in the last 3 years, but certainly over longer time frames. And if we go back farther than the 19 years, which again is not something we present here, there's a clear case to be made that what we're doing would have generated superior results for 30, 40, 50 years. Okay. Now, let's talk about why this would have happened. And this slide right here could easily be an hour presentation unto itself, but we're not gonna do that. We're just going to talk about the fact that there are several things you can do when you're managing a portfolio that tend to win. Now, if you look at the chances of these things we do winning on a day-to-day basis, barely more than 50%, okay? And the first one there, market, just means being in the stock market. A lot of folks might be surprised to know that when you roll up all the data, the stock market goes up when you're measuring individual days barely more than half the time. Now, it's funny, if you reduce that to calendar years, got far fewer periods, the stock market appears to have gone up about 75% of the time. If you go to 5-year periods, 10-year periods, 20-year periods, if you look at 20-year periods, the stock market was inevitably the place to be. There's no 20-year period you can create out of the roughly century of data that we have where it wasn't a good idea to be in the stock market. You were at least positive. But as you get to shorter periods of time, things are less predictable. But more often than not, being in the stock market is a good idea. Doesn't mean you should always be in the stock market or you should always be in the stock market for 100% of your portfolio. Another thing that behaves that way is that we call it the small cap premium or company size. Smaller stocks tend to perform better than larger company stocks. On a day-to-day basis, that's barely 50%. You can easily have 3- and 5-year periods where that doesn't work. You start to get to 10 years, the data is more overwhelming. You start to get to 20 years, it's way more overwhelming. You get to longer periods of time than that, and then it's practically a slam dunk that, you know, we're talking about a 3 to 4% difference per year over very long periods of time for the outperformance of smaller company stocks. Well, we just keep going down the list. Value stocks do better than growth stocks. More profitable companies do better than less profitable companies. There's about 3 or 4 things that you can do with regards to the equities in your portfolio, including just being in the stock market itself, that tend to work for you over time. And then there's a couple things that we look at on the fixed income side in terms of risk and how long the bond is. My point is this: as an investor, what you want to be doing is as many things as you possibly can that are more likely than not to work. And this is exactly the premise that casinos operate on, not for you as the gambler, but for them as the casino. The best situation for a casino is to have millions of players come in every year and place a lot of small bets on games like the slots and things where they've got an advantage. Because if you do that enough times, winning is almost an automatic thing. So it's really the same thing as an investor. How many things can we do for you every day, every week, every year for as many years as possible that have better than even odds of winning? And when you do a lot of that, your odds of winning go way up. Okay, now let's talk about going forward and applying all of those techniques to portfolios and what we actually expect, because at the end of the day, what I want to tell you is where I think the best opportunities are. So we're projecting the next 20 years at portfolios that go from 100% in cash to 0% in equities, which at that point, that means 100% fixed income. So not cash, but all fixed income, all the way up to 100% in equities. And what I'm showing you here is what we expect the benchmarks to do. So that's global equity, U.S. fixed income. So more risk equals more return. To get more return, you got to take more risk. For some people, 100% in equities might make sense. For some people, 0 might make sense. For most people, it's somewhere in between. That's based on your financial plan. That's not so much based on the markets. That's how much risk can you afford to take. But then if we add to that chart the way we invest, you see another line. And it's a little bit superior. It's not dramatically superior, but it's a little bit superior. So we rarely think that it makes sense to have much in cash. That's certainly the case now, where for the most part, cash pays near 0 and inflation's still running at a couple percent, we think. So the data is a little bit weird this year because of the pandemic, but we believe that'll be the case going forward. So we don't have the all cash portfolio. It would be the same as the benchmark, of course, but we think over the next 20 years, doing all the things we do will indeed give you an advantage. Not a massive advantage, but indeed an advantage on a risk-adjusted basis. And in this case, slightly higher returns and slightly less risk. So might actually allow you investing with us to do more in equities than you might otherwise do. So the green curve's better than the red curve. But for those of you that get really long quarterly portfolio reports, you know that's not the end of the story. What we're showing here in purple is as we begin to complicate things a little bit more. So the purple line is one of my favorite lines, because what we're doing here is taking some of your stock market exposure and getting that a little bit differently. It's a little more work on our part, but we have a strategy called hedged equity. And what we're showing here is if you come in to your portfolio and you put half of whatever amount of stock market exposure you've got, maybe it's 80%, maybe it's 60%, we put it into our hedged equity strategy. Hedged equity doesn't add to your return. So, you know, the beginner investor might say, well, if it's not adding to my return, why would I do it? And the answer is simple. We can invest in the stock market with less risk. And that might mean for some of you, you can afford to do more in equities because some of your equity exposure is in hedged equity instead of the more volatile, what we'll call sort of the normal way that we invest in equities. So it's not a return pickup, it's a risk reduction. So if I just look at this chart and I look along the bottom axis, I'll pick a standard deviation of 15%. And we joke about this a little bit internally because I don't think we have yet had a client come to us and say, build me a portfolio that has some amount of standard deviation. It's just not the way most people's brains think. But let's just say for whatever financial planning reasons, 15% standard deviation seemed to be the right amount of risk for you. You would ask yourself, do you want the return you can get from the benchmark? Do you want the return that you can get from letting us do equities and fixed income the way we do? Or do you want the return that you could get for having half of your equities be hedged equity? And that's a higher return. It's a materially higher return. It's probably more than you're paying for us in fees. And the lesson to draw for that is if you're looking at that 15% standard deviation, we might have you 95% in equities to get to that. As opposed to if you were just investing in the benchmark, you might be taking on the same risk for closer to 55% in equity. So there's a lot of moving parts to this. The point is we're closer to that top left corner of the chart. When we go to the next iteration of this, we see us taking the hedged equity out, but now substituting some of your fixed income for another strategy we have called Hedge Yield, which actually buys an equity index but uses a massive amount of hedging to get the risk in line with fixed income, but for a higher return. So in this case, this is a return pickup. It's not a risk reduction so much as it is a return pickup, but it has a few risk benefits. Anyway, we have a substitute for equity, we have a substitute for fixed income, and then if you go to the next chart, we can throw those both in and say, hey, if you're mostly in equities, the hedged equity might be the way to go. If you're mostly in fixed income, maybe we talk about a little bit of hedged yield, or you know, if you're somewhere in the middle, maybe you do need both. But between using those two products to some degree, you know, we've made a material step ahead of the green portfolios, our sort of standard way of investing, getting towards that top left corner. Now, that's not the end of the story. The next curve that we add on here is what it looks like if we invest in the private markets. Now, the private markets are an interesting thing because no two of our investors is likely to have the same private market portfolio. Certainly, an investor that started with us 10 years ago had investments available to them that have since been closed. They might have even had exits already from some number of those, different from someone who came to us 5 years ago or someone who maybe is a brand new client with us. They would have a different private market portfolio. The key there is in the private markets that you understand these are illiquid investments. There are governmental regulations that say not every investor can do them. You have to have a certain amount of assets or a certain amount of income to even be allowed to do that by the SEC rules. But if you can possibly be more diversified. Used to be there was more than 5,000 stocks in the U.S. to invest in. Now it's barely 3,000. It's a lot more companies that are private that you might be able to invest in that actually make you more diversified. But we sort of assume when we're putting this together that there might be more risk. So the risk definitely moves up, but the return moves way up as well. And I'm going to talk about where I think some of the sweet spots are going forward here in a minute. But, at this point, you're one of those clients that gets a whole bunch of statements. Now you're getting K1s, which is the form of tax reporting for most of these private investments, and things are getting kind of complicated. It's not the simplest portfolio, but wow, look how much closer we're getting now to the top left part of the graph, the return you get for the risk you take. We can always complicate things a little bit more, and if we roll forward here a little bit, to say, hey, well, let's add some hedged equity back into that, or the next one is let's add some hedged yield. Or why not? Just throw the whole kitchen sink at the thing. What is everything we can do in the next one? We've got the private markets, we've got the hedged equity, we've got the hedged yield, we've got it in certain ratios for our target portfolios that you might actually do more than. There's probably a way to get this curve even a little bit higher with more private investments. But now compare that to the benchmark, which is the red line. We don't always show private market investments in any kind of aggregate forms because, to be honest, they've actually done better than we're illustrating here. So I think we're being cautious in this approach. But for any amount of return that you want, or we'll go back to what we did before. Let's look at the risk. Let's look at the horizontal axis. Let's look at 15% standard deviation. And let's say, would you like the return you can get with the benchmark, which we think is just under 5%? Maybe you'd like the return you can get if you let us, do everything that we know how to do here, and you're looking at more like 7%. I think most people would rather have the higher returns for the risk they get, or you can start on the left-hand side on the vertical axis and pick a level of return, say 5% after inflation, and say, well, how much risk would you like to take to get that? And again, less risk is always better. So that's what it is that we do. I use the term kitchen sink, but it's everything we've ever talked about. It's everything that we've ever put into presentations captured in chart form here to say, what can we do for you? And again, if illiquid investments isn't your thing and you're scared of that, maybe we should talk about it. There can be clear advantages in the long run to it, but this is just assuming that we're talking with, about investors that can and want to do everything we do. So hopefully that makes the case for our strategies. I will put this chart up, and it's not the first time we've used this. You'll see some of the terms I've already thrown out in terms of hedged equity and hedged yield and other things. But again, our investors don't usually come to us saying, I want a specific amount of risk. They usually come to us saying, hey, here's something I'm interested in. Here's something I'm worried about. And every time you email us, every time you have a phone call with us, every time you're meeting with your advisor, that advisor is at some point passing on, in aggregate at least, to our investment committee in our weekly financial planning meetings, concerns that you have. Certainly, I get lots of contact. We'll take questions here in a minute. You may mention some of these things, but what we found is that pretty much every concern we're hearing about from investors falls into one of about 7 different categories. And so we've listed all of those categories of market risks. And I just put up this table for you to have to say, there's probably some portfolio strategy that I mentioned here or have mentioned on prior occasions that specifically addresses that concern. So in the back of our minds, we're thinking in these terms when we're hearing your questions, and there's a good chance if you've got a concern about the market, we've got that very same concern about the market too, and there's some element of how we invest that is actually purpose-built to deal with that risk. So one more little page or two here to go as we kind of wrap things up. Obviously, these are extraordinary times. We've had this big bounce back that the stock market gave us as kind of a gift, while by all accounts the economy is still slower than we'd like it to be. We've got a pandemic that we're going through, but the stock market recovered, and most of our clients were eager for us to invest on the dip. There were one or two that were not. There were one or two that got scared. There were one or two that came off of their plans. It's easy to get scared. That is not an illegitimate human response to all the news that you're hearing. But if we go forward to the next slide here and we talk about what's happened in the past as a guide for the future, what we're charting here is how many months after a recession before the stock market was actually positive again. And if you look at in most of the recessions over the last century, and you just count them up, in most cases, within 2 years, the stock market was positive again. Certainly about 2/3 of them were. In fact, you might be surprised to look at just 12 months or even 6 months and see how many times, if you look back after the official beginning of a recession, how long it took for the stock market to be positive. So I show you this because as far as we know it, the stock market always recovers. As far as we know it, human ingenuity, entrepreneurialism, the drive to make things better has always been able to overcome whatever challenge we've been faced. And if you're like me and you believe that capitalism is a natural outcome of human ambition, and when we're investing in the stock market, we're investing in capitalism, then it's a pretty reasonable belief to think that this is the way the future is going to operate as well. But it definitely calls out one stark point. Investing in the stock market is not the same as investing in the economy. In fact, the stock market is one of the best leading indicators of the economy. So you could look at our current situation and say, is there a lesson to be learned there? And the lesson would be this: the stock market is essentially recovered. And since the stock market has recovered, it means that the stock market is predicting that, in fact, the economy will recover. It hasn't recovered yet. There's still stresses showing up every day in different businesses. It might even get worse before it gets better. But, there's enough headlines out there right now to suggest we may very well have vaccines for COVID-19 rolling out even before we're at the end of this year, and in much higher quantities next year that would deal with a lot of this. So the stock market every minute, every second is crunching these numbers to come up with what's the best price. And the way things look right now is that the stock market is telling us that things are indeed going to get better, because again, we're barely halfway through the year, and we've already recovered from one of the biggest downturns that we've ever seen. So where are the opportunities? There's a lot of ways to think about opportunities that I want you to keep in mind. And when the first one is don't exceed your risk budget, that might seem like an odd thing to hit the list. But the point is, if you're not exceeding your risk budget before there's a big downturn, then you might have some dry powder, as we say, to be opportunistic and invest on the dip, which most of our clients were able to do back about 3 months ago when things were looking pretty bad. We always say stay diversified, because all of our thesis here is about investing in markets as opposed to picking a particular company, because the fates of companies can change very, very quickly. And that can be a little bit hard to manage from a risk standpoint. Of course, we say don't judge short-term results, and that goes right along with don't lose faith in the markets. you really do have to believe that the human spirit is going to triumph in the end to do this. Of course, buy low, sell high, which sounds great, but that's one of the reasons I think a lot of people hire us is they need someone else to pull that trigger to buy low when things don't look so great. Again, that's worked out fantastically this year. And then the sell high. Sometimes it's nice when the stock market's going up every day, and it can be helpful to have someone else saying, let's keep that risk in check. Let's go ahead and take some of those profits. Second to the last one, consider private market deals. And I think that in kind of a singular fashion might be where some of the best opportunities are for a number of our clients going forward. Private equity has provided fantastic returns to so many of our clients over the years. I think as the future rolls on, we're going to be adding to that more and more private fixed income deals. And when I talk about how low yields are in the market right now, barely above zero, and they could go lower. And I compare that to, what's often a 10% yield available in many private market deals, 2 versus 10, which sounds better. Again, we treat the risk a little bit differently, but I think that might even be where the biggest opportunity is. So there's a lot of moving parts here, as we've shown you. The last one there, ask questions is always super important. In many cases, that's you talking with your advisor. We're going to open up for questions here in a minute with us, but it's really important that we have a dialogue. It's really important that you understand. We think of ourselves as teachers here, and we want to make sure that we know everything about you and your situation, and that you can always have all of your questions answered.